Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Tuesday, May 25th, 2021. Yesterday we saw a big across-the-board rally in most U.S. stocks, led by tech. I hate really to call it a buy-the-dip rally or a new secular move, since the dip we had has been really minor. And since when you really look at it month to date, we're still pretty much flatlining across most major markets. The only notable exception on the upside really is gold, which had been up about 5% and still maintaining that roughly today. And of course, an exception on the downside being cryptocurrencies, which have gotten thrashed. But for the most part, it's been a very stable month. If you were believing in the sell in May rationale, you could say you haven't won much. You haven't by being out of the market. You really haven't lost much by being out of the market. You've missed some trading opportunities, but it's been we've been meandering this month, and that seems to be the case. As I look around at some other factors that might actually influence things, bond yields quietly have been drifting lower, which to me says that the inflationary concerns are moving to the background. And that's probably what's bolstered tech and the general market a bit. You really, unfortunately, cannot disassemble tech from the broader market because, as we've gone through many times, the 7 largest companies make up about 50% of the NASDAQ and about 25% of the S&P 500. And so there's really no way you can get around that. The other thing that I'd like to say, though, is that we were focused on inflationary expectations for so long and how the Fed would react to them, that I think we kind of got ahead of the Fed to a certain extent. And I think yesterday one of the real catalysts was the Fed kept reminding us that they don't seem inclined to do very much in terms of changing monetary policy in response. However, sometimes you got to watch what people do, not what they say. And while I'm not going to say that their activities are contradicting their rhetoric, there are some interesting developments that make me think that maybe it's the rhetoric isn't as strong as it seems. One of the things that I'd been noticing, and I'm not alone in this, by the way, is that the reverse repo facilities of the New York Fed are being utilized again to the tune of roughly 300 to 400 billion a day. I'd say about, call it 350 on average. These facilities had not been touched for the longest time. And reverse repo activity is sort of a very technical, a technical feature. What it is it's a way to actually drain excess liquidity from the markets. And you're saying, well, how does that jibe with monetary accommodation? On a short-term basis, it can. You can argue that the Fed is smoothing their flows of money throughout the system, and basically that there are banks and other financial institutions who just simply don't have access. There's no place to put the money. There's more money than there are places to put it. And what that's telling you is either A, there's too much money sloshing around, or B, there's not enough safe collateral for banks to utilize to get it, basically to get any sort of return whatsoever. So they go to the Fed as a place of last resort. Neither is a particularly good thing. Let's start with the lack of collateral. You can argue that there's not enough government bonds out there or short-term government T-notes, short-term fixed income, because the Fed has been hoovering it all up themselves and then have to give it sort of back to the banks. You can make that case. We can also say that may be a temporary situation because, particularly if the infrastructure deals come to pass and the federal spending continues, that the government will have no shortage of borrowing needs and we will have no shortage of T-notes for banks to invest in. On the flip side are the banks actually competing with the Federal Reserve for that collateral? That can be a trickier situation. The other problem that you have, if it's just simply really too much cash floating around, think of how the cash gets into the banking system. The Fed, the government issues Treasury securities. The Federal Reserve Bank then buys those Treasury securities from the holders in exchange for cash. That cash gets into the banking system. So you can see that the collateral and the cash are sort of intertwined. And now they're basically saying we're going to do the opposite. We need to drain some. I don't know if they're afraid that interest rates might go negative. I don't know if they've been really kind of closed-mouthed about this. But this is one of those like little things to keep in the back of your mind. Are they going to be able to match their rhetoric with action? And that becomes the question that I'm starting to wrestle with. As of now, we can say this is temporary. It's short term. It's something that's certainly considered short term when you see it around the end of a quarter or the end of a year, because banks really need to shore up their balance sheets. They don't really want to be holding excess cash that's not earning any money, so they sort of send it on deposit to the Fed. Now, they realize the Fed is paying essentially no interest on this, so it's really just a place to park money. But the question you start to get into is, is this just becoming truly circular? And at some point, does the Fed kind of recognize that it's truly circular, that they've flooded the system with so much money that no one knows what to do with it? That would be a fascinating situation. As of now, the Fed is holding their rhetorical line. They are asserting that whatever pressures that they're seeing, whether it's inflationary or whatever, are transient. I can certainly understand their view that this reverse repo facility is being used in a temporary manner. It is for now. We'll see if that persists. But that's one of those little things to keep an eye on. I think if this if the pace of reverse repos continues, and particularly if it accelerates, the Fed may be forced to very quietly back off a little bit, and that may have some ramifications for the stock market. The good thing for investors is it typically takes 6 weeks to 3 months for monetary changes to really be reflected in stock prices, so you got some time. But this, I just wanted to put this in your head, something to think about for a Tuesday, and we will talk again soon. Bye-bye.